Investors, welcome back to the channel. My name is Ari Gutman, your value and dividend investor here on YouTube. Now, from video to video, I'm sharing updates on economics from at least a macro standpoint, and of course, just insights along the way as we roll into 2023 about how best to invest. Now, usually I'm talking about value and dividend stocks given the channel, but today I want to go in a bit of a different direction because we are joined by Fidelity's $10 billion man. His name is Michael Gray. He started off as a Fidelity intern, quickly made his way up the ranks at Fidelity, becoming a senior vice president, handling up to $10 billion within multiple funds across Fidelity, and now he is the founder and CEO of Gray Capital Management. It is my honor and privilege to welcome to the channel Michael Gray. Let's get right to it. And Michael, I want to start off by actually going back in time with you and go back to your time as an MBA student while you were at Wharton, and you got an internship at Fidelity. And from that internship as a securities analyst, you ended up getting invited to a lunch with then chairman Ned Johnson. First of all, incredible opportunity that you had, which seemed to have kickstarted your career with Fidelity. But I, right off the bat, want to ask you two questions. Number one, how in the world did you land that particular lunch? And just based off the short story that you could share with us here, what was it that you shared with Ned Johnson at that lunch that essentially brought you back to Fidelity? And it was something that it seemed like Ned Johnson absolutely loved and could not forget about.
Okay. Well, so, as an MBA student, the first thing you do when you get to business school is you start looking for a job. And I, was interested in investments, and, I looked at all the top investment companies, and I was fortunate enough to get an offer for a summer internship at Fidelity. And at the time, Fidelity was the largest, investment management company in the country. And so I started as a securities analyst, and, I'm there doing my job, looking at financial statements, and I get a call from Ned Johnson's secretary. Ned would like to invite you to lunch.
Wow.
So, of course you say yes. And, later that week, I went to his, private dining room, and I was joined by the two other summer interns. And the three of us had lunch with Ned. And, he was a very engaging guy. At the time, he was chairman of Fidelity, but he was very involved in the investment process. He had come up through the ranks. He started as a security analyst himself, then was portfolio manager, and then, was the leader in the mutual fund industry. And it was very intimidating sitting at lunch with Ned. He's an icon, and, I'm just a first-year MBA student. So he, started prodding all of us interns, what our best investment ideas were. And it was a challenging position because, I thought Ned knew a lot more than all of us, but he wanted our ideas. So the other two guys were equity analysts, and they pitched, some equities that they were following. And they were very knowledgeable about, their companies and PE ratios and free cash flow projections. And they, touted the stocks that they thought, would be the best performers going forward. And to me, I, was an economics major in college, and I was a more macro thinker, and I was working in the fixed income department at Fidelity. And, I was just thinking sort of big picture, what's going on in the world. And this was the summer of 1981. And inflation was sort of off the charts. Paul Volcker was the Fed chairman at the time, and he was doing all he could to combat inflation, because inflation had reached high teens, which is unheard of. We've never had inflation that high. And so, Volcker, as the chairman of the Fed, tightened monetary policy dramatically. He was trying to kill inflation, and he jacked up interest rates, short-term interest rates, to very high levels. And, was trying to slow the economy to, get inflation down. And So I'm thinking, I'm here at Fidelity. Fidelity at the time, as I said, was the largest mutual fund organization in the country. We just reached 10 billion of assets under management, and 8 billion of that was in money market funds. That was what everybody wanted at the time. And the reason was rates on money market funds were 16%. That was unheard of. Usually for a cash instrument, you're lucky if you get, mid to high single digit returns. And 16% was just, phenomenal. I mean, it was because of the Fed tightening and the high interest rates. But I thought, this is a virtual risk-free investment, getting high double-digit returns, and relative to the other options, stocks that, I didn't think would do particularly well in an environment where the Fed was tightening. So I said, I thought, 16% money market fund yields, look pretty good to me. So I was invited back for the holiday party in December. And, I went to see the head of the research department just to sort of say hello before we went to the party. And he told me that, Ned had remembered our luncheon meeting, and he remembered what I said, recommending, money market funds. And he said, you were proven to be right, because the stocks that the other analysts had touted, the stock market was down 15% over that period of time. And, we got, good, strong returns and a safe investment. And I was fortunate enough to get a full-time offer after that, and spent, the next 16 years of my career working at Fidelity. And, it was a fantastic organization.
Wow. Wow. Now I have to ask, not only were they safe bets, what did the two other interns, if you recall, what did they recommend at that point in time based on the economic environment you were living in? I mean,
Yeah,
what was the two interns after you guys left
yeah.
lunch? Did you all talk? And
I I don't remember, following up with them on their recommendations, but one of them, talked about, leading consumer good company, and P&G, Procter and Gamble, was the one that he was pushing. And the other was talking about, the cable industry, cable TV companies. And at that time, cable was relatively new. And there were a lot of new channels like HBO and CNN had been recently introduced, and so cable was sort of a hot new technology at the time. But again, in that environment, didn't do well over the ensuing 6 months. So
sure, I'd be curious to see what Procter and Gamble, how Procter and Gamble performed, but
yeah,
nonetheless, even in that economic environment, I mean, you can't go wrong with a simple index fund, a broad market index fund, or an ETF in that regard, just a fund in and of itself. But this leads me to the question. I feel so many young investors really that are out there, they're looking for like the next hot stock,
yeah,
something sexy, if you will, to invest into. And I feel as a younger investor at that point in time in your life, you're an MBA student, you're at Fidelity, and you're at the this luncheon with Ned Johnson, and you're
yeah.
talking about investing into a fund. Now, it seems like you've almost had this more of a prudent investment approach, perhaps even before you got to that lunch. And even now, today, to your investment approach, which we'll get to in a hot
Yeah.
second. But who was it that influenced your investment approach, or where do you think you got this more of a prudent style of investing?
So it's a good question. I think it boils back to my background in economics. I always sort of had a macro view of the world, and there are different types of investing. One is top-down investing, where you look at a broad macro picture and then filter down, drill down into more specific things. Another approach is bottom up, where you look at individual companies and then build a portfolio that way. And so I've always viewed myself as more of a sort of top down type person, with the macro view as the overriding, and then you sort of fill in the details after that. So I think it's something that I learned in graduate school as well. And it's stayed with me.
Sure. Did you have any investment icons that you looked up to, perhaps in your younger years or even now today?
Investment icons. There are many, the legends of the field. Warren Buffett was, well known and well regarded, even back then. And, I think he still is today. On the bond side, there was, a guy from PIMCO, Bill Gross, who was, the leading bond investor at the time. So, I didn't really focus on anyone in particular, but, followed sort of general themes that came from the big names. Yeah.
Sure, sure. Now this will lead us right into the next question here, because it's actually one of Warren Buffett's, approaches as an investor. He's a long-term investor, as we all know, but he will, from interview to interview, sometimes talk about what it feels like during market turbulent times, perhaps, in, say, March of 2020, or even as we enter more of an uncertain 2023. From your time at Fidelity, or even now, Gray Capital Management, what's that feeling like when the market dips 10, 12, 15%? Is there a stomach pinch that you have, like a gut drop? And how do you remain calm during such uncertainty?
Well, it's challenging, and there certainly has been a lot of volatility, in the markets over time. The most memorable period for me was, October of 1987, when, the stock market dropped 22% in one day, which is the largest, intraday move ever. And, it absolutely is gut-wrenching. The market's down 100, 200, 300 points. And, it's like trying to catch a falling knife. It's a horrible feeling. And you can't really do anything in that type of free fall. Liquidity dries up, and, it's hard to make, thoughtful decisions, in that period of time. And the way to deal with it is to try to step away from that and have a prudent, diversified long-term approach that anticipates there's going to be volatility in the market, and willing to accept downdrafts, knowing that there are going to be upticks later. So if you have a diversified portfolio, you have to understand the risk that's involved in the market, and there are ups and downs, and you have to sit with it.
Sure. So again, it's that safe approach of being well diversified in the market. However, heading into a year like 2023, where it seems like there's still a vast amount of uncertainty out there.
Yeah.
I just read in your most recent Seeking Alpha article, actually, about the yield curve inversion. And you had shared in this article, which, by the way, will be posted for all of you out there in the bio of today's video. Click on that link to the Seeking Alpha article, where you can read firsthand Michael's account here of the yield curve inversion that we haven't seen in, I think you said, 40 years. Is this something that we should be worried about heading into the remainder of 2023? And how exactly would you say we should start to prepare?
Yeah, so it's an interesting period of time. And, the yield curve is normally positively sloped. As you extend out the curve and take on more risk, you generally get more return. One of the underlying themes of investing is the greater the risk, the greater the return. So you should get a higher yield for taking on more risk. But occasionally there are periods of time where that's not true. And the current period is one of them. We have an inverted curve, which means that short rates are actually higher than long rates. And the inversion right now is the most extreme it's been in the past 40 years. It rivals the inversion that we experienced in 1981. And it's meaningful because, analysts have determined that yield curve inversions are usually a pretty good predictor of recessions. And over the past 40 years, an inverted yield curve has been 5 for 5 in predicting recessions. So right now we have another inverted curve, and the question is, are we going to have a recession? And, you know, I don't know for sure, but given what's going on in the environment, I think there's a decent chance that that will happen. The metric for inverted yield curves is there's usually a lag between when the curve is most inverted and when the recession occurs. The peak inversion this period happened just 1 month ago in January, and the lag is usually 12 to 18 months. So if we do have a recession, it's not going to happen tomorrow. It's going to be somewhere down the road. And there are other factors that suggest, we may be heading towards a recession. One, the Fed has been tightening very aggressively for the past year. And although the market has been looking for the Fed to pivot and stop their tightening and maybe start lowering rates again, that's not going to happen anytime soon. The Fed has been steadfast in saying, they're going to fight the inflation battle until inflation gets back to their long-term target of 2%. And although, we peaked at 9.8% several months ago, and now we're at like 6.5%, so it's come down a little, we're still well above the 2% target. And the Fed has learned from past experience not to give up the fight prematurely, and they're not going to do that. So they're going to continue to tighten. We've had many economic indicators that suggest their tightening to date hasn't had the desired effect. And so rates are going to, at least on the front end, are going to continue to rise. I think there's, weakness coming down the road. And as a result, one of the features that's happened recently that has been unusual for the past, 15 years is that, again, short rates are high relative to the rest of the curve, like it was in 1981. And in fact, 6-month Treasury bills just hit 5% last week for the first time since 2007. And, we went, 15 years with short rates at virtually zero. And now you can invest in, relatively risk-free instruments and earn 5%. And that's a much better return than we've had recently. So that's something safe and compelling in this period of volatility. And the article that you referenced, Inside the Yield Curve, Time to Barbell, it's an investment strategy. If you're going to invest in bonds, there are different ways to do it. And the barbell is taking advantage of that inverted curve and having a heavy weighting in the highest yielding component, which is, short rates, and offsetting it with a longer term position to, give you exposure to bonds, but benefiting from the inverted curve.
I almost feel like if we had another round 2 of a Fidelity lunch, this would be the Michael Gray moment for you to go back and say, this is what we should be focusing on. And I want to dig in a little bit deeper because you mentioned so much there. And video to video, whether it's on YouTube here or even at work, I'm always sharing with investors that we very well, amidst this uncertain 2023, could see more ebbing and flowing in the market. Jerome Powell is very likely to continue to raise interest rates. But do you have a timeline in mind, or are you foreseeing a certain month in the next 12 months or so in which you think a recession could really hit? Or it's hard to put a pinpoint on, but what's your outlook?
Yeah. So the timing is always difficult. You never know for sure when it's going to happen. And recent indicators suggest the economy is still strong. I mean, the most important indicator people look at is employment, and employment has been strong. We're at 50 plus year low in the unemployment rate, at 3.4%. So, there are job layoffs that are being announced. A lot of tech companies are sort of cutting back, and we may see more of that. But, with last month's number, that was offset by new formations of jobs in, smaller companies. So, I think ultimately the unemployment rate is going to go up. But, it's going to take some time. And, when I can't say for sure. But the Fed is going to be vigilant and fighting inflation, and it's going to take time for it to come down. And it's something that's going to happen, I think, down the road.
For sure. I honestly, I feel that until we really get this pivot from the Fed, we'll continue to get that ebbing and flowing. But just like you shared, I definitely will be more layoffs. And we've seen a vast amount of the layoffs thus far coming from the tech sector. Of course, a lot of the high growth companies. But, I'm personally waiting like sector by sector for these layoffs to come about. And interesting to note that the last employment report that came out, it was 517,000 jobs added to the U.S. economy. As you had mentioned, the unemployment rate right now at 3.4%. We haven't seen this low of unemployment since 1969. So a very robust labor market. And something, that I actually really wanted to bring you on the channel for is because you are very well invested into funds. And funds, honestly, the safest way to go, I think, in the market when you're investing. It's always fun to pick individual stocks, but when it comes to indexes or ETFs, your funds are the foundation of a portfolio of safety, I think. But I wanted to pick your brain a little bit about how exactly an investor, whether a beginner, more experienced investor, or someone that just wants to kind of set it and forget it, how do we go about picking like the right fund? There's a lot of advice out there. The one I always run with is pick a broad-based ETF or index fund that covers really the whole market, so you can't really lose. But, and that advice comes from Mr. Bogle himself. But I wanted to hear from you, the fund mastermind, if you will.
Yeah.
How exactly should an investor be looking at a fund, and how do we know which one's the right one for us?
So, mutual funds are really fantastic for individual investors because they give you so much. One, they give you professional management. And for an individual who doesn't really know how to pick stocks company by company, having professionals do it is a plus. Two, they give you diversification. And, the basic rule of investing is, don't put all your eggs in one basket. And it's easy to be attracted to the big names that, performed well and everybody loves those companies, but you need a diversified portfolio for any investment to minimize your risk. And mutual funds give you instant diversification. And the other benefit of mutual funds, or ETFs is, they're pretty liquid. It's easy to move in and out of them. And so, those are a lot of benefits for individuals. And more diversification is better than less. So, you mentioned, broad-based index fund. That's, an amazing way to start. But, you can diversify more with, depending upon your risk tolerance. If you want aggressive funds, you can go for, specialty funds or, growth funds. Or if you're more conservative, you can go for, more dividend-oriented funds. You can diversify with fixed income as well. There are many different tools. And the large mutual fund organizations like Fidelity and Vanguard offer tremendous resources with information about the various products. And, you can learn a lot from, the tools that they provide to help an individual investor, get the diversification that they need.
Absolutely. I so happen to be a Vanguard guy. I know you're Fidelity, I think, through and through. Now, I chose actually Vanguard because at the time at which I was sitting with my father, actually, we were talking about which brokerage to go with, and Vanguard had some of the cheapest fees. Do you look at fees when you're about to invest into any of these funds, or what should we keep an eye on in regards to fees?
Yeah, I mean, fees are, absolutely important, and you have to look at them. And so that, is something to consider. But, looking at the long-term track records and, the performance of the different managers, that's important too. And, I'm a proponent of, more diversification is better than less. So, you can, have several funds, you don't need just one. So.
Sure. Sure. Now, a beautiful twist to the story is
Okay.
that Michael Gray actually happens to be my uncle. So I can go way back in time. And there are countless amounts of times in which my family had traveled for the holiday or for a visit to Boston. And my uncle, Michael, had pulled out the newspaper and would always sit in front of myself and cousins with the paper open and a bunch of ticker symbols. Now, I was not only fascinated, but I was interested, and I was curious. I was trying to listen in to the best that I could in what he was sharing. And although you're big on funds, there was a stock that was always mentioned. It was Apple. But I wanted to actually ask you this question and put you on the hot seat because I can, as you're my uncle. What stock, if any, has been like your most successful investment? And I know that you're a
Yeah.
big investor into funds, but has there ever been a stock that
Yeah.
like an individual stock you invested into, or what's been
Yeah.
your best, highest returning stock pick?
So that's a great question. And again, as a professional in the investment field in fixed income for 40 years, you look at the long-term returns. And historically, over time, stocks have the highest return. They average about 10% a year. Bonds are the next, and they average about 5% a year. And this is over a 95-year period. And then cash money market funds average 3% a year. They're the safest, but you get the least return over time. But there are periods where, one will do better than the next. And occasionally cash outperforms both stocks and bonds. So as a professional investor, I've looked at the big picture and have sort of followed the long-term returns. Having said that, one of those days when you were at our house looking at the paper and we were talking about Apple, it came about because my 13-year-old son at the time was interested. He liked the Apple products and he wanted to buy Apple. And so, as a lesson to him, we said, sure. And we bought some Apple stock. And it's one of the few individual stocks, that I've purchased over my career. And I have to say, my son had a lot of foresight because it turned out to be the best investment I've ever made. And, this was when he was 13 years old, 16 years ago, and the stock has returned on average 25% a year, which is 2.5 times the long-term average. And, we all know Apple is a great company. It's Warren Buffett's largest holding as well. Nothing unique in buying Apple. It just was buying it at the right time. And 16 years ago was a perfect time to buy it. And it's been a phenomenal investment. And again, the best investment decision I, as a professional investor, ever made was one that my 13-year-old son recommended. So
I love it. Apple is also one of my largest positions, and I will admit that my cousin has me beat. He hasn't been invested into Apple longer than I have been, but I have been steadily growing that Apple position, which leads me to the position. So Apple was one of your top performing stock picks, but in terms of particular stocks for 2023, because I mean the tech sector has just been completely devastated.
yeah.
Do you have your eyes on any particular stocks? Not that you're investing into them, but do any stocks
Yeah.
excite you? Like Apple, every time I figure
Yeah.
out what Apple, is on the verge or cusp of making, I get excited. And then thereafter that, like Google's down right now, but Microsoft's got Chat GPT. Google's coming out with Bart, and so it's very exciting. But then, of course, with the economic environment that we're living in, do you have any particular sectors or stocks that you're at least interested in? Or
Again, I sort of look at the big picture from a macro point of view, and Apple's a great company, and will continue to do well. They, among the tech companies, they actually make money, and they have fantastic margins, and it's a great product. But given the broader economic environment, I think there's a lot of risk in owning stocks right now. And one thing that we haven't really talked about is sort of the macro environment over the past 15 years. Starting in 2008 with the great financial crisis, the economy domestically and worldwide was at risk of collapse, and the Fed stepped in and really saved the economy from a catastrophe. And they did it with what's been called quantitative easing, which was intended as a short-term fix, but it existed for 14 years. And the quantitative easing was injecting liquidity into the system. The Fed stepped in and they bought bonds from banks that were at risk of collapsing, and they took the risk off of the bank's balance sheet and they put it on their own balance sheet. The Fed they started with an $850 billion balance sheet, and by the time they were done 14 years later, they increased their holdings by a factor of 10 to almost $9 trillion. And the Fed is the largest owner of treasury bonds. They're the largest owner of mortgage-backed securities. They have the largest investment portfolio in the world. And that liquidity created the run-up that we've had in asset prices over the past 14 years. Stocks, were at all-time highs until a year ago. Real estate was at all-time highs. Bonds were at all-time highs with record low interest rates. And I think a lot of this was due to the Fed's quantitative easing. A year ago, they recognized that this, created not only inflation in asset prices, but also inflation in consumer prices. And they started the tightening that they've been embarking on over the past year. And the Fed tightening had two components. The one we've talked about already is they're raising short-term interest rates. But the second part of the Fed tightening is, what's called quantitative tightening, which is a reversal of the quantitative easing over the past 14 years. And that's draining this liquidity from the system in terms of reducing their balance sheet. And that they've been doing quite slowly. They started with a $9 trillion balance sheet a year ago, and they've, got it down to, 8.3, 8.4 trillion. So they have cut it, but it still is pretty big, and they have a much longer way to go in terms of draining liquidity from the system. And so this is another factor that causes me to be cautious about other asset prices, because I think the quantitative easing created an asset bubble in all asset classes. We saw it in stocks, real estate, digital currencies, everything across the board until a year ago was at all-time highs. And now that the Fed is deflating with their quantitative tightening, it's, causing some deflation of that asset bubble, but I think there's more to go. So that's why, I'm cautious. I think that the, 15-year high 5% short-term yields that are relatively risk-free are attractive in an environment where the Fed is deflating the market with their quantitative tightening. So that's, a cautious approach. That's, how I'm looking at things right now.
Of course, a very cautious approach and a very steady hand, it seems, at investing, which actually, I want to throw this question in here for you. Again, put you on the hot seat. Let's just say, hypothetically here, that we had Federal Reserve Chairman Michael Gray
Yeah.
As the Federal Reserve Chair right now, would you do anything differently? Would you do anything quicker? I know there's been a lot of talk that Jerome Powell has actually been moving too slowly or that he reacted too late. Would you have done anything differently? And I know it's a bit of playing Monday morning quarterback, if you will, but I'm
Yeah.
curious to know from your perspective.
Um, I think they're doing what they have to do now. And the vigilance that, Fed Chairman Powell is showing is good. I think he needs to do that. As a criticism, and it's easy to be a Monday morning quarterback, he should have stopped the quantitative easing earlier and started the quantitative tightening earlier. But, again, that's, looking backward. But, he is doing what he has to do right now. And, this is an issue not only for, us domestically, but it's a global issue. And it's something to be concerned about. Other central banks of the world had a similar situation to us where they did quantitative easing and just recently started quantitative tightening. The Bank of England, the European Central Bank, they're following suit. And even the Bank of Japan, that was the earliest to get involved with quantitative easing, they started 15 years before us. And even they, who have remained vigilant with their QE policies, they're recognizing that it's time to change. Japan has had inflation as well. It's not as high as it is the rest of the world, but for them, it's way above, their goals. They want a solid 2% inflation rate, and they're over 4 right now. And they're going to have to change their policies. So the entire world is, going through this quantitative tightening. And, there are so many unknowns. The war in Ukraine is an unknown. And so, it's hard to predict with any certainty, but, the world as a whole is on this quantitative tightening. And that's what, makes me cautious that, there may be more downside in some of these risk assets.
Sure, absolutely. A subscriber of mine, Citizen of the Year, he is asking, what do you tell your clients that they can expect for their returns? And what's roughly the timeline of those returns? Now, I'd like to believe that this question is, again, just based off the fact that we're heading to a very uncertain year. And I know you're a longer term investor, but I guess this question is posed that you have a client in front of you. What are you advising them or sharing with them in terms of what they can expect?
So, you can't offer clients any certainty with what the returns are going to be. That's a rule of investing is, there are risks and there are no guarantees. But you can look at, past performance and, make some projections of what to expect over a period of time. I know people want, the highest returning asset with the least amount of risk. I only want things that go up 20% a year and, don't give me anything that's going to go down. But, that's unrealistic. That's not how investing works. Over time, the numbers that I shared with you earlier, stocks return on average about 10% a year. Bonds return on average about 5% a year, cash 3%. Those are sort of the long-term numbers that you can think about. In some years, it's going to be more, other years, it's going to be less. But, there are no guarantees. And so, if you have a diversified portfolio, it will weather the ups and downs of, the different asset classes. And that's, that's the prudent thing to do for individuals over long periods of time, be diversified so that, even if one of your assets is down significantly, it's offset by something else that's doing okay.
And another question from yet another subscriber here, Richard Song. He is asking, what pieces of advice could you offer investors, again, beginner or more experienced, for an investor, your retail investor perhaps, to just get better at investing?
So, for anybody who wants to get better at investing, you have to spend some time with it and learn as much as you can. There are lots of resources available. Tip Ranks is one that offers, advice to retail investors. The, general financial press offers advice to investors, and the more knowledgeable you are about the different products and the different things to consider, that's more helpful. Each of mutual fund companies, any investment company, has educational material that they provide to investors to explain the risks of the different products and what people should consider. So I think if you want to get better at it, you have to educate yourself and learn more and follow it more closely.
Amazing advice. And we're wrapping up to our final two questions here. Now, I'll ask the first question that I have for you is, you had a tremendous career, very inspiring career, at least for myself, to look up to you as an investor to another investor. And this question now, I want to think, I guess the next steps of your life, or what you'd like to see unfold. You've had, again, an amazing career with Fidelity, an amazing track record, and then that led to Gray Capital Management. And you are also writing for Seeking Alpha, of course, jumping on channels like mine here to do an interview for all of us. But what's next in the Michael Gray story?
Well, so, I just continue to follow, the things that I'm interested in. I like what's going on, in the financial news, and I try to stay abreast of it. And, with my research and writing, it's topics that are of interest to me that I think are underfollowed by the general mainstream financial press, and want to share those ideas with others. And other than that, just spend time with my family and friends and enjoy life.
I had a feeling that that answer was coming. And so I guess we cannot expect a Federal Reserve Chairman Michael Gray anytime soon. But again, with a steady hand in investing, I certainly hope you continue to do interviews like this and continue to write, because you have so much insight for all of us to learn from. And with that, our final question, I'd love to know what parting words of wisdom that you have for investors across the board, for all of us, as we try our best in 2023.
So, it's just reiterating some of the things that I said before for, any investor, to, follow the basic rules, diversify your risk, understand the risks that you're taking, and, invest for the long haul and not get, too swayed by something that is hot and talked about now. Just follow the basic rules of investment and you should do okay.
Fantastic advice. Again, that steady hand in investing, I wouldn't expect anything less. Investors, there you have it. Michael Gray, and famed the $10 billion Fidelity man himself, here with us, bringing insights for the market, economics across the board. And of course, now his career with Gray Capital Management. Again, a lot of wisdom. His article to his most recent Seeking Alpha article is down there in the description. Please go ahead, give that article a click. You can read through to many of his other articles that he writes for Seeking Alpha as well. And we certainly hope to have you back on the channel. I certainly hope to have you back on the channel as the economy may get a little bit more uncertain and a state of flux, where we're going to need that steady hand of yours to come back and share some more words of wisdom. Michael, thank you so much for joining me today on the channel.
Well, thank you for having me, Ari. I appreciate it.